Welcome to the Deep Dive. Today, we're going to take you on a bit of a journey to understand market cycles, a topic that affects everyone, whether you're actively investing or just trying to understand the economic world around you. Our guide for this deep dive is the brilliant Howard Marks and his book, Mastering Market Cycles, an investor's guide. You ready to unlock the secrets of the market and learn how to use those cycles to your advantage?
Absolutely. And you might be surprised to learn that these cycles are more than just financial patterns. They're practically everywhere.
Okay, I'm intrigued. So it's more than just stocks going up and down.
Way more. Think about it. Fashion trends, the real estate market, even the popularity of certain foods. They all ebb and flow in cycles. Marx argues that these cycles are driven by a fascinating mix of economics, human psychology, and yes, even things like how easy it is to get a loan.
So are you saying there's a connection between, say, the latest TikTok fashion trend and the availability of mortgages?
It might sound strange, but there's a thread there. Both are influenced by broader economic conditions and that very human tendency to get swept up in what everyone else is doing. When times are good and money is flowing, people are more likely to take risks, whether it's buying a house they can barely afford or robbing a questionable fashion choice.
That makes sense. But back to Marx, he talks a lot about learning to listen to the market. What exactly does that mean? It's not like the market is actually whispering secrets, right?
Right. It's not about literal whispers, but about becoming attuned to the market's signals. It's about recognizing the patterns, understanding the underlying forces that drive those patterns, and figuring out where we are in the current cycle.
It's like being a detective looking for clues to solve the mystery of what the market will do next.
Exactly. But here's the thing. Even the most seasoned investors can't predict the future with 100% certainty. What Marx teaches us is that it's more about understanding the tendencies of the market. It's about recognizing that certain conditions tend to lead to certain outcomes.
Okay, so no crystal ball, but a roadmap of sorts.
That's a great way to put it. And having a solid understanding of how markets work is like having a detailed map. In his book, Marx provides a framework for developing a winning investment philosophy.
Fill us in. What's the secret sauce?
Well, it's not really a secret, but it does require dedication. Marx emphasizes the importance of a solid technical foundation, a deep understanding of market mechanics, and constant learning from other investors and your own experiences.
Learning from experience, huh? I can definitely relate to that. Remember that time I bought a ton of, well, let's just say it was a learning experience.
We all have those moments. The key is to take those lessons and refine our understanding of the market. Now let's dive into the different types of cycles Marx covers.
Sounds good to me. Let's get cyclical.
First up, the economic cycle, the one that impacts everyone, even if they don't realize it. Think about how government actions like raising or lowering interest rates are attempts to influence the economy. It's a complex system with lots of moving parts.
So the government is like a conductor trying to keep the economic orchestra in tune.
That's a great analogy. And just like an orchestra, sometimes things get a little out of sync. Then you have the profit cycle. Now, a company's profits are even more sensitive to changes than the overall economy.
Why is that?
Well, think about it this way. Companies have fixed costs they have to pay no matter what. Rent, salaries, etc. When revenue drops, those fixed costs eat into profits much faster, making profits swing wildly.
This is like a seesaw, with profits on one side and fixed costs on the other.
Exactly. And then there's the human element, the pendulum of investor psychology. This is where fear and greed really come into play, driving market swings from wild optimism to deep pessimism. Think of it like a roller coaster.
Ooh, a roller coaster fueled by emotions and money. Sounds a bit scary and exciting at the same time.
It definitely can be. Now buckle up, because Marx considers the credit cycle the most powerful of them all. Even small changes in the economy can cause massive shifts in how easy it is to get credit.
Interesting. So
Yeah.
it's all connected. But why is the credit cycle so impactful? What makes it the main event?
Imagine a company needs a loan to expand. But because of a slight economic downturn, banks are hesitant to lend money. Suddenly, businesses can't get the funds they need, slowing down growth even further. This can create a ripple effect throughout the entire economy.
So it's like a domino effect,
Yeah.
starting with a small change in the economy that ends up impacting everything.
Exactly. And it's not just businesses that are affected. Consumers feel it too when applying for mortgages, car loans, or even credit cards. Understanding the credit cycle is crucial because it impacts so many aspects of our lives.
Wow. I'm starting to see just how interconnected all of this is. And Marx doesn't stop there. He dives into specific cycles like distressed debt and real estate.
Right, it does. But before we get into the specifics of each cycle, Let's zoom out and focus on what this all means for you, the listener, because ultimately that's what matters most.
Absolutely. We need to make this knowledge actionable. So what are some of the key takeaways from Mark's book? What can our listeners deal with this information?
One of the biggest takeaways is the importance of understanding where we are in the current cycle. Your investment strategy shouldn't be static. It needs to adapt based on the market's position within these various cycles.
And there's no one-size-fits-all approach.
Exactly. Remember, there's no magic formula that always works in investing because the market is constantly changing and reacting to new information. Understanding cycles is about recognizing the patterns, assessing the risks, and adjusting your approach accordingly.
So it's more about being adaptable and strategic than trying to predict the future.
Precisely. Marx even lays out specific stages within cycles to help us see the bigger picture. For instance, he outlines the 3 phases of a bull market. It starts with a few astute investors sensing an opportunity. As things improve, more investors jump on board, recognizing the upward trend. Finally, you reach a point where everyone believes the good times will last forever, and that's where things can get dangerous.
So that's what people mean by irrational exuberance.
Exactly. On the flip side, during a downturn, there's a similar progression. The economy slows down, negative news circulates, worry turns to panic. And suddenly fear becomes the dominant emotion, driving the market down further.
So how can we navigate this wild ride without getting thrown off? How do we avoid making those emotional decisions that could hurt us in the long run?
That's where Mark's emphasis on survival comes in. He stresses the importance of not getting swept up in the emotional extremes of the market. Understanding cycles helps you avoid major losses that can take years to recover from. It's all about being prepared.
I'm getting the feeling that this understanding of cycles could be useful in more than just the investment world. It seems like it could apply to any area where there are ups and downs, right?
You're absolutely right, and Marx dives into that as well with his fascinating concept of the cycle of success.
Tell me more. I'm all ears.
This is where things get really interesting, because Marx argues that success can actually breed complacency. When things are going well, it's easy to become overconfident and let our guard down, but that's often when we make mistakes that can lead to future failures.
Whoa. That's kind of a mind-blowing concept. It's like a built-in paradox.
It is, and it's something we need to be aware of, not just in investing, but in all aspects of our lives, whether it's our careers, relationships, or personal goals. That tendency to become complacent after success can be a real danger.
I'm starting to realize that this deep dive is about so much more than just understanding the stock market. It's about understanding human behavior, recognizing patterns, and learning how to use that knowledge to navigate the ups and downs of life itself. But we've only scratched the surface. There's still so much more to explore.
You hit the nail on the head. Understanding these cycles gives us a framework for making smarter decisions, not just financially, but in every aspect of our lives.
So it's like Marx is giving us the secret decoder ring for understanding the world around us. But let's go back to those specific cycles he talks about. We touched on the distressed debt and real estate cycles. Those sound a bit intimidating. Can you break those down for us?
Sure, let's start with the distressed debt cycle. Think of it this way. When companies struggle financially, sometimes they can't repay their debts. These debts are then considered distressed. Savvy investors, understanding this cycle, swoop in, buying this debt at a discount, hoping the company will recover and they'll make a profit. It's a high-risk, high-reward game.
So it's kind of like bargain hunting, but for debt? I never thought of it that way.
Exactly. Now, the real estate cycle is one that many people can relate to. Think about how property values go up and down over time. When the economy is booming, demand for housing increases, driving prices up. But when things slow down, demand weakens and prices fall. Understanding the cycle is crucial for anyone looking to buy or sell real estate.
Okay, that makes sense. But how does all of this tie back to what Marx calls listening to the market? How do we apply this knowledge in a practical way?
Well, remember how we talked about your investment strategy needing to adapt based on where we are in the cycle? When markets are near the peak of a cycle, think of it like the top of a roller coaster. It might be time to reduce your exposure to those riskier assets.
So when everyone is feeling super optimistic, it's actually a sign to be a bit more cautious.
Exactly. It's about recognizing those moments of irrational exuberance we talked about earlier. Marx suggests shifting some of your investments into more conservative holdings like bonds or even cash. It's all about protecting your capital, riding out the potential storm.
Okay, that makes sense. But what about when markets are down? Is that the time to go all in?
Not necessarily all in, but it's definitely a time when opportunities emerge. Savvy investors who've been paying attention to the cycles recognize that fear has driven prices down, often below their true value. It's like a sale at your favorite store.
So it's about having the courage to be a contrarian, to buy when everyone else is selling. That sounds a bit nerve-wracking.
It can be, but remember, that's where discipline and a clear investment philosophy come in. It's about sticking to your plan and not getting swept up in the emotional roller coaster of the market.
So it's about thinking long-term and not letting those short-term fluctuations shake your confidence.
You got it. Marx highlights this with his breakdown of a market downswing. He described how a slowdown in the economy leads to negative news, which weakens the market. This worry can escalate into panic, fueling a downward spiral.
So it's like a chain reaction
Yeah.
where fear feeds on itself.
Precisely. But understanding this progression can help us prepare mentally and financially for those inevitable downturns. Remember, it's a cycle, and what goes down must eventually come back up.
This reminds me of something you mentioned earlier about Marx's focus on survival. Can you elaborate on that a bit more?
Absolutely. Marx argues that the most important thing for investors is not necessarily making huge profits, but avoiding those catastrophic losses that can wipe out years of gains. It's about staying in the game for the long haul.
So it's like a marathon, not a sprint.
A perfect analogy. And understanding cycles allows you to pace yourself, to conserve your energy for those challenging stretches, and ultimately cross the finish line.
I'm starting to see how powerful this concept of cycles can be. It's not just about making money, it's about building wealth sustainably and ensuring you're around to enjoy the fruits of your labor. But let's be honest, staying disciplined and rational when everyone else is panicking is easier said than done. How can we actually cultivate that kind of discipline?
That's the million-dollar question, right? Marx stresses the importance of having a robust investment philosophy, one that's not based on fleeting emotions, but on solid principles.
It's like having a set of guiding principles that act as your compass, keeping you on track even when the seas get rough.
Exactly. It's about developing a clear understanding of your risk tolerance, your investment goals, and your time horizon. This provides a framework for making decisions, even under pressure.
This conversation has given me a lot to think about. It's amazing how something as seemingly complex as market cycles can be broken down and understood in a way that feels empowering.
That's the beauty of knowledge, isn't it? The more we understand about these patterns, the less intimidating they become.
It's fascinating how these principles of cycles seem to apply to so many areas beyond just the financial markets. It's like a universal language that we can use to understand and navigate the world around us.
You're absolutely right. We've talked about real estate, fashion, even human psychology, but these principles can be applied to so much more. Think about politics, technology, even your own career.
Oh, I never thought about it that way. Give me an example. How could this apply to my career?
Well, think about the different stages of a career path. There are times of rapid growth, plateaus where you might feel stuck, and even potential setbacks. Understanding these cycles can help you approach your career strategically.
So it's about recognizing those periods of stagnation as part of a natural cycle and using them as opportunities to learn new skills or explore different paths. It's not a sign of failure, but a chance to recalibrate and prepare for the next upswing.
Exactly. And just like in investing, understanding these cycles can help you manage your expectations, ride out the tough times, and ultimately achieve greater success in the long run.
I love that. So it's about applying the wisdom of the market to the map of our lives. But we've talked a lot about the challenges and potential downsides of these cycles. Let's shift gears and talk about the opportunities they present.
Yeah.
How can we actually use this knowledge to our advantage? How can we ride these waves to greater success?
That's a great question, and it's where things get really exciting. Remember, every cycle has two sides, a downside and an upside. And those who understand these cycles are better equipped to capitalize on both.
Let's break it down. Let's say we're at the bottom of a cycle. Things look bleak. Everyone is panicking. What's the opportunity there?
That's when you have the chance to buy low. Think of it like a Black Friday sale for investments. Prices are down. But if you've done your research and you believe in the long-term potential, that's when you can snag some amazing deals.
So it's about having the courage and the foresight to see beyond the current gloom and recognize the potential for future growth.
Exactly. It's about being contrarian, going against the herd mentality, and trusting your own analysis. Now, on the flip side, when we're at the peak of a cycle, what's the opportunity there?
Well, I guess if you've been riding the wave up, that's the time to take some profits, right?
Yeah.
To cash in on those gains before things turn south.
You got it. It's about recognizing those moments of irrational exuberance and having the discipline to sell high. Remember, it's not about timing the market perfectly, but about recognizing those opportunities and acting accordingly.
This is all starting to click for me. It's about being aware, being prepared, and ultimately being in control of our own destiny, regardless of what the market throws our way.
I couldn't have said it better myself. Understanding cycles empowers us to make informed decisions, to navigate the ups and downs with greater confidence and resilience. It's about turning those waves of uncertainty into opportunities for growth.
I'm so glad we dove into this topic. It's truly eye-opening. But before we wrap up, I want to circle back to Marx's idea that success can breed complacency. I think that's such a crucial point, and I want to make sure our listeners understand how to avoid falling into that trap. Can you give us some specific advice, some actionable steps we can take to stay vigilant and keep that growth mindset, even when things are going well?
That's a fantastic question, and it's something we should all be mindful of, regardless of our level of success. I think one of the most important things is to cultivate a culture of continuous learning. The market is constantly evolving, and we need to evolve with it.
So it's about never resting on our laurels, never assuming we have all the answers.
Exactly. Make it a habit to read, to listen to podcasts like this one, to connect with other investors and thought leaders. The more we expose ourselves to new ideas and perspectives, the less likely we are to become complacent.
I love that. It's about staying curious, staying hungry for knowledge, and always seeking to expand our understanding of the world. Any other advice?
Another key is to embrace feedback, even when it's uncomfortable. It's easy to get caught up in our own success and start to believe we're invincible. But feedback, even critical feedback, can be incredibly valuable.
It's about being open to different perspectives, even those that challenge our own assumptions. It's about being willing to learn and grow, even when we're at the top of our game.
Absolutely. And remember, it's okay to celebrate our successes, to acknowledge our accomplishments, but don't let those successes blind you to potential areas for improvement. Stay humble, stay hungry, and never stop striving to be better.
This has been an incredibly insightful conversation. I feel like we've only scratched the surface of what Marx covers in his book, but I'm already starting to see the world through a different lens. This whole concept of cycles is so powerful and has so many applications beyond just investing. It's really about understanding the rhythm of life itself.
I couldn't agree more. And remember, understanding cycles doesn't mean we can predict the future with certainty. It's about recognizing those patterns, understanding those driving forces, and using that knowledge to make more informed decisions.
I'm ready to dive deeper into these cycles. Any final words of wisdom for our listeners before we wrap up this part of our deep dive?
Sure. Remember that cycles are all around us. They're a fundamental part of life, of the markets, of everything. Embrace them, learn from them, and use them to your advantage. And never stop learning.
It's amazing to think about how these cycles are constantly playing out around us, often without us even realizing it.
It's true. And one of the things that makes Marx's insights so valuable is that he's not just an academic theorizing about these cycles. He's a seasoned investor who's been in the trenches, experiencing those market swings firsthand.
He's walked the walk, so to speak. That real-world experience definitely adds a layer of credibility to his perspective.
Absolutely. He understands that investing isn't just about numbers and charts. It's about human psychology, about recognizing those emotional forces that can drive markets to irrational highs and lows.
And we've all seen those examples play out in history, haven't we? The dot-com bubble, the housing crisis, these were all fueled by those very human emotions of fear and greed.
Precisely. Think about those classic bubbles. People get caught up in the hype, convinced that this time is different, that the rules no longer apply. They fear missing out, so they pile in, driving prices to unsustainable levels.
That's like that game of musical chairs we talked about earlier. Everyone is scrambling for a seat, but eventually the music stops and someone gets left holding the bag.
Exactly. And those who understand cycles, who can recognize those signs of excess and frothiness, are the ones who are more likely to avoid getting caught in those market meltdowns.
They have the discipline to step away from the table when the game gets too risky, even if everyone else is still playing. But that takes a certain level of self-awareness, doesn't it? The ability to recognize those emotional triggers and not let them dictate your actions.
It does. And that's why Marx emphasizes the importance of developing a robust investment philosophy, one that's grounded in logic and reason, not driven by those fleeting emotions of fear and greed.
So it's about having a clear set of principles, a North Star to guide your decision-making, even when the market is throwing you curveballs.
You got it. And that philosophy should include a deep understanding of risk. Remember, Marx argues that the key to successful investing isn't about hitting home runs or picking the next hot stock. It's about survival.
It's about staying in the game, avoiding those big losses that can set you back years.
Precisely. He emphasizes that one of the biggest mistakes investors make is taking on too much risk, especially when markets are high. They get caught up in the euphoria and forget that what goes up must eventually come down.
It's like they're trying to time the market to catch that falling knife
Yeah.
and often end up getting cut.
That's a great way to put it, and that's why Marx advocates for a more conservative approach, particularly for individual investors. It's about protecting your capital, managing your risk, and not letting those emotional swings of the market dictate your actions.
It's about playing the long game, recognizing that slow and steady wins the race.
Exactly, and that's where understanding cycles becomes so powerful. It gives you that long-term perspective, that ability to see beyond the short-term noise and recognize that these fluctuations are part of a larger pattern.
You know, as we've been talking about this, I keep thinking about how these principles apply to so much more than just investing. It's about understanding the ebb and flow of life itself, isn't it?
Absolutely. Think about your career, your relationships, even your own personal growth. There are cycles in all of these areas. There are times of rapid growth, times of stagnation, and times of setbacks.
And if we can recognize those cycles, understand the forces at play, we can navigate those ups and downs with greater wisdom and resilience.
Precisely. We can use that knowledge to make more informed decisions, to prepare for those inevitable challenges, and to capitalize on those opportunities that present themselves.
It's not about eliminating those ups and downs altogether. It's about learning to ride the waves, so to speak.
Exactly. It's about embracing the cyclical nature of life, understanding that those fluctuations are a natural part of the journey.
You know, it's funny. We started this deep dive talking about market cycles.
Yeah.
But it feels like we've uncovered something much more profound, something that touches every aspect of our lives.
I think you're right. At its core, understanding cycles is about understanding human behavior, about recognizing those patterns that repeat themselves throughout history, in the markets and in our own lives.
And once we understand those patterns, we can start to make choices that are more aligned with those natural rhythms. Choices that lead to greater success, fulfillment, and yes, even happiness.
Well said. It's been a pleasure exploring these ideas with you today.
Likewise. And to our listeners, thank you for joining us on this incredible journey. We hope this deep dive into the world of market cycles has given you a new perspective on the markets, on life, and on your own personal journey.
Remember, cycles are inevitable, but our responses to those cycles are what truly shape our outcomes.
So keep those cycles in mind, stay curious, stay informed, and keep diving deep. Until next time, happy investing and happy living.